This is lesson 3 of the Seido Trading Learn to Trade series. In lesson 1, we covered the 3 bar types, and in lesson 2, we learnt how to read those bars with context. We looked at the signs of momentum and how traders respond. This lesson is about trends and is the next layer for your knowledge. We'll define what trends are, how to identify them, and how to stay with them using the EMAs. So by the end of the lesson, you'll be able to look at any chart and identify opportunities to trade trending markets. Plus, we're giving you access to a complimentary TradingView indicator to enhance your contextual awareness during a trade. So stay tuned. A trend is any series of higher or lower prices over time. It entirely depends on how much context you take into consideration. A strict definition of a bull trend would be higher prices with higher swing highs and higher swing lows. A bear trend would therefore be a series of lower prices with lower swing highs and lower swing lows. Trends can exist over any period, from a few candles to hundreds of candles. What defines a trend depends on context and the time frame you're analysing. Trends can exist on lower time frame charts, while the higher time frame chart is within a trading range. Trends offer the clearest opportunities for retail traders to profit from the markets. Traders need to be able to identify when it begins, recognise the momentum behind it, and stay with it. There are 2 common tools that can assist in identifying trends. These are moving averages and trend lines. Neither is essential, and there are plenty of traders who trade without them. However, they provide very clear orientation to how the market is currently operating. When used correctly, moving averages and trend lines can provide useful context, meaning that they can support your read of price action. Both act as dynamic support and resistance zones. I say zones because it acknowledges how traders respond when price interacts around them. A good rule of thumb is that around 80% of breakout attempts fail. So what is this telling you? A breakout against the prevailing trend only succeeds about 20% of the time. Traders will use moving averages and trend lines as dynamic support and resistance within a trend. In trends, pullbacks to the EMA represent continuation behaviour. Traders will use them as opportunities to interact with the market. What you'll notice when you're looking at charts is that most trends are made up of regular bull or bear candles, or trading range candles. It's not strong candles. Strong candles are rare. A professional trader recognises the market structure, the trend, the context, and is able to participate without needing a textbook candle. When drawing trend lines, it's important to draw them correctly and in context, based on what you're trying to analyse. Major trend lines connect clear swing highs or lows, and they're visible on higher time frame charts. These levels are widely watched. Traders across many time frames and institutional algorithms reference them as key support and resistance. Minor trend lines are smaller and they're drawn within shorter price moves. Traders should always remember that trends evolve over time. As the trend evolves, any trend line we draw will inevitably have to evolve with it. So markets broadly move through 3 phases as price transitions gradually. Trends naturally weaken over time and usually evolve into trading ranges. This process takes time to unfold and for traders to recognise and to respond to the transition. A trend line drawn at the start of a trend will typically need to be redrawn multiple times. So what do I mean by that? This is a bull trend on the Nikkei. If we were to draw a trend line like this, we've clearly got a break of trend here. This would become the new trend line. Once again, price breaks the trend line. We need to draw it again. What you end up with is something that looks like this. The key takeaway is that even though we got trend breaks here, here, again in here, all through here, is that they're very discretionary. It relies heavily on you being able to recognize the overall context of what's happening in the market and being able to recognize that a breakout of a trend line isn't necessarily a failure of the trend. Moving averages are just a tool that traders use. They work across all time frames, from 1-minute charts to daily, weekly, even monthly charts. And some of the most profitable traders have built strategies using just moving averages. Traders use shorter period moving averages like a 9 or a 10 to highlight strong momentum and catch short-term trends. They'll use longer period moving averages from anything from a 20 all the way up to a 200 to show broader trends. After a period of consolidation, when price moves away from a moving average with momentum, the first pullback to the moving average is often the most reliable level of support or resistance. So this is a 5-minute chart of the Nikkei mini futures. I've gone ahead and added a 20-period moving average to the chart, and I've also annotated the trading range in blue. Hopefully you remember from lesson 2 that this is a strong candle. This is the type 1 momentum that we spoke about. It's a very strong bullish candle closing well above the trading range. Traders were happy to buy on the EMA, and this was the result. Good traders are always observing context, so a trader who trades the daily chart will look to a weekly chart for context. A trader who trades a 5-minute chart may use the 15-minute chart for context. So how do we achieve this? Well, the most common EMA across all time frames is the 20-period moving average. An easy approach to understanding the context is to overlay the higher time frame 20 moving average onto your lower time frame chart. So at Seido Trading, we've developed a higher time frame EMA specifically for this. So it can be added to any TradingView chart. You select your higher time frame that you wish to display. So because we're on a 5-minute chart, we'll select the 15-minute period. We then select the EMA length that we want. We can also select smoothing to be applied, or for it to appear exactly as it would on the higher time frame. So as we can see, we've got both the 5-minute 20-period moving average as well as the higher time frame 15-minute 20-period moving average. As explained, we had momentum away from the moving averages, and the first pullback to the moving average is the most reliable. So we get an interaction with the 20 period on a 5-minute chart, and then we get an interaction with the 20 period on the 15-minute chart. By combining these moving averages on one chart, the EMAs define trend direction and structure, making it easier to see the broader market context. This is another example of the higher time frame EMA being applied to a lower time frame chart. So this is the recent bull run in silver that we had at the end of 2025 and into the start of 2026. I've gone ahead and used the Seido Trading higher time frame EMA overlay, applying a 20-period weekly moving average to our daily chart. As you can see, when price sold off, it found support on the weekly moving average. Moving averages and trend lines are trend following tools. That means they only work when the market is trending. Trend following tools should not be used within the context of tight trading ranges, as we discussed in lesson 2. In a tight trading range, price oscillates above and below the EMA, producing unreliable signals. And this is why recognizing momentum is so important. It's why I spent so long in lesson 1 and 2 walking you through exactly how to identify momentum. Our ability as traders to take one of the easiest trades, that is the pullback to the EMA, relies on us being able to identify that momentum. EMAs can also indicate trend weakening. This is why they're so useful for traders. When a trader sees a significant amount of price action below the moving average in a bull trend, it may indicate that the trend is losing momentum. At Seido Trading, we've found that it's statistically less likely to revisit a prior swing high before testing a higher time frame moving average. This doesn't automatically imply that price will fall though. Sorry guys, it's not a free trade. Price can trade sideways and wait for the higher time frame moving average to just simply catch up. So let's go through and highlight a few examples of where this happened and how it played out. So this is the Nikkei mini futures on a 5-minute chart. As we can see, we had a good response off the higher time frame 15-minute moving average here. Price then had significant momentum. So the first pullback to the 20 had good response from traders willing to buy. We then got an extended period of price action below the moving average. So what this does is it sets up that probability that it's less likely to revisit the high before it tests the 15-minute moving average, which is exactly what happened. Here's another example, this time on a daily chart of the S&P E-mini futures. So we had a big bull run from late 2023 to early 2025. I've overlaid the weekly 20-period moving average. When we start to see a significant amount of price action under the moving average, we know that statistically it's more likely to test this moving average before testing the high. This is not enough price action below the moving average here. This is though. So once again, it tested the higher time frame moving average before retesting the high. Here again, this is a good example though. Statistically does not mean certainty though. It lets us make more informed decisions as to the likely outcome of events. Hopefully what you've recognized throughout this lesson is that traders don't need to pick the direction before it has shown itself. We can use the higher time frame context and understanding of the trend to position ourselves for defined setups as price pulls back. So here's the coursework for the lesson. Head over to seidotrading.com, find our indicators, and add the higher time frame EMA onto your chart. What I want you to do for the lesson is to call up the ES futures on a daily chart. Use the higher time frame EMA overlay with a weekly 20-period moving average. This is the chart that we looked at in the lesson. Observe how price followed the EMA in the trend from late 2023. Every time it pulled back after strong momentum, look how it reacted to the EMA. Now, using your knowledge from lesson 1, examine the candlesticks that appeared on the EMA. Were they strong candles or were they trading range candles? Take as much time as you need to annotate your charts with everything that you've learned from lesson 1, 2, and 3. Even go candle by candle. The effort that you apply here will really make a difference in the end. You should be looking for characteristics of momentum, trading range behavior, and looking at when price breaks out of the trading range, what happens when it pulls back to the EMA for the first time. As always, the annotation checklist is here to help you. So that's it for lesson 3. You now know what a trend is, how to identify it, and how to use moving averages and trend lines to stay aligned with it. And we learnt that when price pulls back to retest the moving average for the first time, that creates a defined setup with clear risk, and traders will take this opportunity. Next time in lesson 4, we'll look at some common trading indicators, understanding what they measure and where they are useful. I'll see you there.